All right, in honor of only the third U.S. male to win a medal at the 3,000 meter steeplechase race in the Olympics in the past 100 years, Kenneth Rooks won the silver today, coming out of nowhere. So I'm wearing my Cougars, my BYU Cougars shirt in honor of his spectacular race that he had today, coming from had a pretty decent race planned and came from behind and made a big push at the end and ended up taking silver. So big deal for a lot of BYU fans here in this area that have been rooting him on. He's the same one, some of you may have heard, he actually fell in the race at the U.S. Championships, ended up in last, made it all the way back and won the U.S. Championships. And the race, the time he had today was the second fastest time ever in U.S. history. So really good race and proud of him, and it's been a fun Olympics so far and a lot of great stories. Not so fun in the market, so I'm going to break down today's move in light of what we've been talking about in terms of like anticipated correction. You know, some of you asked what that means, so I talked a little bit more about what that means here in today's video. Breaking down the sector moves. There are a few things that are showing up that may point towards us not having a deeper pullback. So I'll talk about what those are and what to watch for the rest of this week. And then we'll take a look at our trade idea stock that is just kind of catching down to the rest of the market with earnings coming up and what it might do and how to trade that. So let's go ahead and get started. Today is Wednesday, August 7th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old trades, whether we should stay in them or not. We also put on today's trade already before the market closed. Come down to the bottom, click this heart, it opens up this tab. Hit that like button there. Same thing here, click on this thumbs up icon, it opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. Thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started with the market forecast here on the S&P 500. You can see the down day today after starting off with a pretty good return. In fact, when you look at the gap today, we had a 1.2% gap to the upside. But unlike this other day where we actually finished to the upside, we came all the way down and finished down 0.2%. So almost a 2% swing from top to bottom. Quite the move in the S&P. So what it did was the near-term line continued higher because you know we are off the lows on Monday. Barely getting above 40. It was actually a lot higher when we were at the highs of the day today. In fact, I tweeted out about it earlier this morning. But the problem is now, so it is above 40. Remember, it has 2 days to go from being below 40 to above 80 if we're going to get a bullish move. And on the first day, typically you like to see the momentum line be above the near-term line. So the last 4 near-term moves out of bearish territory, all 4 of them started with the momentum line being below the near-term line. All the other 3 of them turned into bearish near-term peaks, and there's a decent likelihood this one would too. This one will too. We'll see by the end of the week. But as of right now, you would expect that this one will turn down. The near-term line will turn down, maybe go up a little bit more, depending upon how much of a gain we have tomorrow, but ultimately turn lower by the end of the week. Would be the expectation, especially with the momentum line again dropping down to extreme lows. Remember, anytime the momentum line drops in the reversal zone, generally the near-term line follows down at least towards it, if not all the way into it, like we've seen these past few times. Especially when it gets to extremes, right? It's one thing for it to dip down a little bit below 20, and then the near-term line only gets into bearish territory. But for it to get down to extreme lows, usually, like you see right here, usually then the near-term line follows suit. Here's another example over here where it dropped to extreme lows and the near-term line followed suit. Another example right there. So we'll see. I mean, obviously the near-term line's not above 50. It's not in bullish territory, and it's definitely not above 80. So whether or not this would be a really bearish peak if it only barely clears 40 before reversing back down to the downside. But you do have dark pink shading in a red line. We do have we're still more than 5% below the 30-day moving average, which is in the 5th percentile now. Oh, again, only higher in the past year than 2 days ago. So we are significantly below the 30-day moving average, which generally we don't get this far down below it when we are just having an intermediate pullback. So in other words, more than likely this market sentiment line is also going to make its way into bearish territory, which means that takes a while, which means we might be bearish here for a while. Again, that doesn't mean like we're going to go down every single day. And again, when you look at 2022, which is the last major correction we've had, obviously we didn't go down every single day. We actually had bullish intermediate runs there. So but this takes time before, on a typical correction, for the low point to get set in. You're going to have some moves to the upside. You're going to have you're going to have the intermediate line make its way back up, at least out of the reversal zone, if not above 40. And then the question then would be whether it fails to get above market sentiment. And so that we'll see. I don't think that will happen this week, but it could start to happen at least by next week to get that intermediate, to get the pullback bounce that we anticipate. And whether or not that bounce fails remains to be seen. As of right now, when you look at the size of the move we've had so far, we are down 8.5%. Like we haven't cleared Monday's. Well, let's see here. Did we get? No. So Monday's close here at 51.86 was about 13 points. That still is an 8.5% mark. I think we're going to go maybe a little bit lower than that before we start to bounce back up. Let's take a look at some of the other indexes. The NASDAQ 100, of course, has fallen 10%. Has been a lot more bearish. It's down 8% below the moving average, which is a pretty high level. It's a higher beta index, so it's going to have bigger numbers. The intermediate line is still it has been in the reversal zone this entire time. It's still in there. Again, the near-term line made a little bit bigger of a move. It got all the way up to almost 50, but again, the momentum line's not above it. Not only is it not above it, it's at extreme lows. So again, suggesting that this will be a bearish near-term peak again. For the NASDAQ 100. Looking at the Dow Jones Industrial Average, its near-term line is trying to get above in fact, it did close slightly above the intermediate line. The intermediate line now has dropped into bearish levels and probably will drop below the 20th percentile tomorrow, as the Dow has really been, over the past week, catching down to where the S&P and the NASDAQ, same thing with the Russell 2000, it is now in the 10th percentile this past year in terms of how far below the moving average. It still hasn't turned red yet. Won't turn red tomorrow unless we get a big move down. But it's close. Like, we definitely have dark pink shading, but we have crossed into bearish territory now, and it will also probably cross, depending upon what if we rally, how big the rally is. Most likely will cross below the 20th percentile tomorrow. Again, the momentum line's oversold, so it suggests that the near-term line will probably produce a bearish peak here and follow down into, if not tomorrow, by the end of the week, follow down into bearish, the oversold levels down there. All right, now let's take a look at the weekly chart. Again, showing a pretty strong weekly candle. Let's get a little bit bigger than it was here yesterday, so we will just activate that and move it down just a little bit lower. But again, you can see a significant size candle here compared to other typical pullbacks, and also compared to when we've had other pullbacks that started or that turned into corrections. So it's that big candle. This is not your typical pullback candle, and we're at the lows of the week right now, so we're set to have a pretty decent sized candle next week as well. Depending upon how bullish or bearish we end up next week. Obviously, you have 3 red arrows across all the major indexes, and they, again, have a red line on the S&P 500, the NASDAQ, and the Dow. You don't have the red line yet, which is the falling moving average. But again, we have 4 days straight and the NASDAQ's been a lot more than 4 of 3 red arrows. So we are definitely in intermediate decline to say the least. And when you break it down in the 2-line version of this chart, we are working our way down to the 200-day moving average. We broke the 50, and now we're working our way down, and that's what happens during pullbacks generally. Now, the weak pullbacks you can see don't make it all the way down there to the 200, but this is a deeper pullback, and the MACD is definitely lower. In fact, the MACD, that's one of our lower MACDs that we've seen since. You can see it can go lower, so just because it's this low doesn't mean it can't go any lower. It did go lower back when we did make it down to that 200-day, and again, I expect that will actually be the case by the end of this week. That it will probably go just a little bit lower as we ultimately end up down closer to the 200-day moving average. If you look at like the diamonds and the Russell 2000, which remember had been relatively bullish, obviously the gap between the 50 and the 200 is a lot closer. We did touch the 200 on the open on Monday, and now we're working our way back down. You can see the MACD is still got actually quite a bit of ways to go if it's going to catch down to kind of a correction level pullback to start this decline. Let's take a look at some of the other oscillators, like we always do. With the gap up and the higher high, it actually brought the negative indicator down. It's still above 30. It's actually above 35. Your positive indicator still below 20, which again, with the ADX above 25, you still got the dark pink shading there. I remember IWM has been only a recent move to the downside, and you still haven't broken 20 yet on its positive indicator. If you look at the RSI and the CCI, again, we are at bearish levels, still below 40 and still below minus 100. And if you look at the weekly, we are still below minus 100 with 2 more days left. Remember, it's really important because breaking below minus 100 is a sign of correction, right? Again, a correction being a pullback where when we bounce, it fails. And then we end up going to lower lows and ultimately below the 200-day moving average for an extended period of time. If you take a look at the Ichimoku cloud, so we do now have an intermediate trend strength. In fact, we are very close to mature trend strength now. We're almost below 5 there, and we are slightly above 80. So just like that, and you can see that we are back below the cloud, now obviously with a very strong negative rate of change, and our cloud has definitely turned pink there. IWM is still slightly above its cloud. Its cloud's been very thin, and it doesn't have a trend developed yet, and you still actually have a slightly positive rate of change. Now we look at the Bollinger Bands and the Keltner channels, and you see that the bandwidth is really high. It's cleared that 10 level. Again, just for, this is a apples to apple. This is a relative indicator, so you can look at it historically as well. It doesn't just get bigger because the index is bigger. So if I were to throw on a line here, where 10 is, here, let's do this. Let's just get it exact, right at 10. So you'll see that again, it's not common. The last time we were above 10, it was on a bullish move up to the upside, and again, we cleared that 10 level when we started the pullback. See, on all these other pullbacks, we didn't get above 10. But over here, when we started early 2022 with the first pullback of that correction that ultimately led to a failed bounce, it did clear 10. And remember, this is lagging, so it's even if we were to start to bounce up, it's still going to move up higher for another, for a few days at least. You can see the fourth quarter 2018, that first pullback also cleared above the 10 level. So that's a key level for the Bollinger bandwidth when we are to help us determine whether or not this is just a pullback that we'll bounce off of right now and get going, or if it's going to turn into a failed bounce and then lower lows and ultimately a period of time below, like I said, the 200-day moving average. We are still in the lowest quartile, and when you look at the Keltner channel, we are back below the lowest Keltner channel with some increasing momentum down there. The green dots, we never did change. When we changed from bullish to bearish, we didn't get the red dots. We went straight down there. And if I were to zoom out a little bit so you can put that momentum in context, again, you can see Again, more momentum than your typical pullback, and the same type of momentum that you get during an early stage of a correction, right? A bigger pullback that leads to a failed bounce, and then, like I said, lower lows in an extended period of time below that 200-day moving average. I mentioned to you the 200-day hull has turned red, so you can see that there. We are well below the parabolic SARs. The 20-day is obviously red as we're below that. The PPO is at very negative levels. Again, for some context on this, going back to early 2022, this is about where you get either at the end of a pullback or when we're starting one. When you're starting a correction, again, the size of the candle we had on Monday, how significant that was. We ended up with a couple transition candles, so we'll see if they transition to a bullish move. I expect they'll actually transition more of a bearish move by the end of the day, because remember, as of right now, tomorrow's candle will open at 524, but we're trading right now in the after hours at 516. Now again, that's after hours, but the close was at 518, so 518 is about right here. So that will be the size of the body once we open tomorrow, depending upon where we ultimately open. So it looks like we won't transition to a bullish candle, that will instead continue to trend lower to the downside. Again, but the big deal here is the fact that the 200-day hull has turned red, and that we're so far below the 200-day hull with how big of a candle that we got on Monday. Let's take a look at the intraday chart. Here we go, the intraday chart here. Again, we got a slightly higher high, and we actually did again get above last week's low point, but didn't run away with it, which would have been the ideal scenario. Get a good gap to the upside, run away with it, close up here by the end of the day, start to fill in some of that gap there, and we'd have been just fine, right? That's kind of the scenario I was hoping to see this morning. But the failure and to start to fill in that gap, and the fact that we had so much to fill in, and then the fact that when we did fill it in, we tried to bounce but failed and broke below yesterday's close, suggested that we would finish more bearish. And that's ultimately what we did. And you can see the no new low point, but the high continues to move down to zero. You can see the size of the width. We still have about another week before the high starts to drop. So any new lows we get will just make the size of this width get bigger and potentially get up above that 10 threshold, which again, like the Bollinger Band, that's an important level when you're a pullback that is more than just a pullback. All right, we did get above 10 over here again on the rally off of that, but we generally don't get above 10 unless 10%, which is the size of that, that rubber band stretching, unless it's a pullback that leads to more than just, that leads to a failed bounce and then lower lows. Let's take a look, and you can see that when you visualize those highs and lows here, now the average for this is broken down into bearish levels. And remember, the weekly being below 40 on the weekly is very significant, but now we've been bearish so long that the average is down here. And again, just for some context on what that looks like when you do get into a correction, so there's early 2022. The longer we stay in this bearish level, these are corrections, these shaded areas are corrections. You can see that you spend more time below 50 on the orange line and less time up above. It's very brief when you get these moves up above. This one never did get above 50. This peak did. This one did not get above 50 there, and this one did, only to come back down and get below 20 at the washout phase there in October. And over here as well, and COVID also got below 20. So kind of keep an eye on this and watch for any crossover of the orange line, which is the 20-day average, of the blue line, which is the visualization of where we are right now inside of the 20-day range, obviously closing a lot closer to the lows of the 20-day range. If you look at today's volume and trading range, let's see here, pull that up. You'll notice the range was above average again. So we're moving that ATR up above average on the volume again. So both the average for the volume and the ATR continue to move up. Again, for some context on that relative ATR, which we can look at, Again, 2% is an important number, and we're inching closer to that 2% level. Typical pullbacks, we don't get anywhere close to 2%, but we do when it's more of a pullback, more of a correction, and that's where we are. Volume, you can see it's really, really light, so volume has a long ways to go. If we're gonna, and that's kind of where this money flow indicator is. Like, it's still at bearish levels and still dropping, and we are, the last time we were at this level was right about in here, and you can see the one positive so far on this decline that we could kind of point to, even if you were just to go to like right here. We closed at 517.19. That's probably the last time we were this close. We were at 517.14 there. So this is probably the last time we were closest to this 518 close that we're at right now. And if you look at where the volume was, the money flow indicator, you'll notice on the way back down, we are not back down to those levels on volume. So that if there's one thing that we can point to that says, to kind of hang our hat on and hope that this is just a pullback, just like this one, and we'll bounce back up, is that we're not getting a big degree of selling. So for an example, let's say like back over here, if you were to go back to another instance when we were kind of at similar levels, so kind of at this instance right here, you can see from this point over to here, the volume was down to a little bit lower actually. So there was some, we could be bearish there for a little bit longer, and that's not the case right now. So that's just a small. In fact, the last time the money flow was at this level would be kind of at this point right there. So the money flow is equal now, even though the price is a little bit lower. So that's kind of something that just to kind of hope, just a little hope on. That we might be a little bit more bearish in the price than what the volume is telling us in terms of how bearish we should be. Finally, the VIX. The VIX dropped today before rallying back up. Still ended up only up by 0.5%, so very, very small. But the issue we get with the VIX, and not a lot of people are talking about, is the VVIX. The VVIX is still at 150, which suggests a pretty strong likelihood that the VIX will remain elevated. So until the VVIX drops hard, it's going to be hard for the VIX to drop hard. They kind of go together. You can see they're highly correlated. So we need the VVIX to drop a lot more. And you can see the VIX has dropped quite a bit, and it's still above the 100% mark. But until the VVIX drops, then you're gonna get some wild swings in the VIX, but it will probably stay above 20 and stay above this 100% level, which really that's the important level to kind of keep an eye on. When I've told you before, if we're going to bounce up and be done with this, we need to get below 100%, which we did at the open today, and then we really need to get below this 95% mark. And we were looking good this morning, but this rally is not so good. We're almost back above the 105% mark, which, again, is your typical standard for an intermediate decline. We've already hit the 115% mark, which is also the typical standard when we're actually, either finishing or, in this case, starting a correction. All right, now let's take a look at how these asset classes are performing. So I'll pull up the just today. Let's look at today alone. You can see remember how the Qs they're just killing things on a 3-month basis, and obviously that's not the case now. So if I take a look at how things are performing now, just today, you can see commodities actually had a pretty decent day. Remember, everything started off really well from a risk appetite standpoint. The Qs, EEM, EFA, IWM, and then it started to go downhill. By the end of the day, IWM and the Qs were down the most. Emerging markets actually held up pretty strong thanks to stronger commodities, right? They tend to benefit those commodity currencies. The EFA did pretty well. Again, international stocks did pretty well despite some strength in the dollar there. But bonds were down big. So in this case, which lately it's been yields, falling yields that have been stocks and bonds have been correlated with each other. But lately that correlation has been going negative. Well, today you can see the yields went up, and that's again that has been positive for stocks, or has been negative for stocks until recently, where the correlation again between bonds and stocks went positive. So again, you look at TLT here. Again, we've had a very strong negative correlation after being really positive for so long. But today that wasn't the case. Again, stocks and bonds moved in the same direction. They both went down. Bonds went down, stocks went down, partly from some people saying due to a really bad 10-year auction. Some of the people who described the 10-year auction talked about like it was like a horror show. It was that bad. So that's kind of what produced that correlation back to being a positive correlation, at least for today. Whether that ends up being persistent or not remains to be seen. But as of right now, yields working their way back up to 4%. I don't know if we'll be able to get back above 4%, but we'll see if that ends up being the case. Again, we're still below. We are so oversold. So a rebound up to moving averages, so in other words, the mean over these time frames is very likely. You look at like how far away we were from just the 8-day exponential moving average. It was pretty extreme. Like, let me zoom out so you can see some context on this. We'll just go out to 10 years. So right here, if you follow my cursor, we have to go all the way back to pretty much COVID. To be that far below the to the downside, below the 8-day exponential moving average. So that's a pretty stretched rubber band that you're going to bounce back. And now, whether or not we break back above these 8 or the 17 remains to be seen. Most likely, probably not, because we are definitely breaking down below the 200-day moving average, and TLT is there is a renewed interest in long-term bonds right now. Even if the auction was pretty crappy, we are definitely breaking out, as I mentioned to you before on the weekly chart. Last week's move was a pretty decent breakout move that you're bound to get a return move like this. But as of right now, I kind of view this as just a return move. You can see the gap between the 50 and the 200-day moving average I've shown you before is the biggest that TLT has ever seen, and you can see it's starting to move up. Like, let me zoom out so we can get some context on that. But you see how it's starting to move higher, and I expect that will continue to be the case, that we will continue to move higher on this through some ups and downs and start to fill in that gap. And if bonds and stocks go back to their positive correlation, great, right? But again, that will only happen if we are inflationary. So that will generally mean that inflation expectations will start to rise again, which I don't know if we want that. Most likely with falling yields, which is what we're getting across the board, that is usually a deflationary environment. So that generally means that stocks and bonds will not have a positive correlation, will remain in this current negative correlation state. So if this continues higher, that generally means will coincide with more weakness to come in equities. If you look at today's breadth, we start off again so good. It was looking so good. We'll look at the Coppet curve at the end of the week as we get closer to the end of an expiration cycle. But here's our McClellan oscillator eventually. And you can see we're still below the minus 35 level, which is the trending level. So we are still, that's still some pretty bad breadth, and we are moving away from the positive 500. We were trying to get back up above it. We worked so hard. We got up to new highs. We worked so hard just to clear that 500 barely, but we're back down and we're going lower. And when you look at the number of stocks above their 50-day moving average, which you can see earlier this morning was above 250, by the end of the day today, it got back lower. Eventually, this will load up. Here we go. 234. So we went big swing in terms of, again, really bad breadth. Now, it hasn't broken 200 yet because it does that even just during pullbacks. As you saw during the last pullback, we broke through 200. So, that kind of go, again, on one hand, that could be a good sign that we've dropped this much. In fact, when you look at some of these other breadth charts, like how far away we are from the 50-day moving average. Here, let me bring these up. Here we go. So this is the number of stocks below the 50-day moving average by 5% or more. We have cleared the 30% mark, which is an important level. and then how far away the average price is below from the 50-day is 1%. So that generally means we have more stocks in this, like we're breaking the 40% mark, and we just haven't yet. So that's probably another good sign that we're as bearish as we are, and we still haven't really, like, it hasn't been a full scale. As we saw with the Dow and the Russell, they just kind of barely started to go south. So that's a good sign. Again, one more positive sign. There's not very many of them, but a positive sign that it might just be a pullback and nothing more than that. Here's the new highs and new lows index. Let that load up here. There we go. Remember, it had dropped down. Whoops, excuse me, it's not. Let's try this again. New highs and new lows. It had dropped down, way down to minus like 700 here. Again, that's, you can see what happened at the end of 2021 into 2022, and you can see it can go a lot lower. Remember how we talked about here the number of new lows that we have, and you're in that 4% range. Here, let's go back to this chart. Well, here, let's see how many we got today. So see, it's NY low, and let's take that off of the log scale chart. So we're up to 58. So again, we've had a couple of days above that key 4% level. We did not get that today. 4% would be 115-ish right now. So again, it's not as broad. Partly because we were so bullish to begin of the day. But that's, again, just if there's one thing we can kind of hope for, that it doesn't turn into a correction, which means, again, a failed pullback bounce. Remember, when I say a failed pullback bounce, this is what, because I got that question on Twitter. What I'm talking about is, we get this drop down here of, 10% plus or minus a point or two, and then we get a bounce back up. So something similar to this. That's at least 5%, because you can't get a green tag unless it is 5%. And this one, you can see, it only took 4 days, but at least 5% that ultimately then fails and this failed at the 30-day moving average, and then we drop down the lower lows and eventually below the 200-day moving average. Right? That's what I'm talking about with the fail. So we are susceptible to that right now. As of right now, we are susceptible because of how deep this pullback is in. But we can avoid it and really kind of get a move back up to new highs soon. And if there's anything that points to that as a possibility, it's low odds, but if anything that can point to that possibility, it's the fact that volume hasn't been so bad and the breadth hasn't been nearly as bad to this downside, at least yet. Now that can change in the next, if we continue lower the rest of the week, and like as I was talking about, because maybe the NASDAQ doesn't fall as much, but maybe you have more of a decline in some of these other charts like the Qs. If I were to take a look at the Qs relative to IWM, right? If we were to, if IWM were to start to fall a lot more in the diamond, then the breadth would look really bad and the volume could start to turn south as well. So we'll see if by the end of the week, if that ends up happening, you'll end up with more lows, right? And so those are the kind of things that we need to kind of cross our fingers for by the end of this week that doesn't happen. And that if we do go a little bit lower, it remains on very few lows, very not very bad breadth, and not very bad volume either. All right, now let's take a look at how the sectors have performed today. And again, we started off really, really well. So we'll take a look at just today's chart here, August. And it goes 7th, and you can see here that we started off with technology doing well, not surprising, but interesting that energy and financials also were your early leaders in the clubhouse. So by the end of the day, technology went from the best winner to the biggest loser. So big swing. Discretionary, I mentioned to you, I believe either in this video or I might have mentioned it on Twitter. I know I tweeted this out. That one thing that's really been hammered is discretionary stocks relative to staples. That's a big drop. Like this is a lot of damage, technical damage that you really need to repair, get back up above 2.25, get back above these levels and get going. And obviously that's not been the case, and you can see even at the open, discretionary was underperforming, only outperforming healthcare. And then by the end of the day, it was the worst performer. So and these outpaced staples. By the end of the day, staples and utilities ended up being winners, along with energy and financials. Again, all of these sectors have negative their relative strength charts have negative correlations with the S&P 500. So you can see the ratio chart here of XLE to SPY still, I mean, it's not as negative as it was, but it's still at a negative 75%. And then when you look at financials here, you think, okay, well, these are kind of cyclical. Maybe, I mean, we're just kind of rotating. Well, no, that it still has a 62% negative correlation. It's not as negatively correlated, but when they outperform the markets, that's generally not the best thing. And right now, they're the ones that are outperforming the markets. As you can see, you got staples, healthcare, real estate, utilities are your four best. I mean, they're the most up to the right out of all of these. Other cyclical areas are kind of doing okay. Even communication services have been doing okay, but these two bellwethers down here are struggling, and it's hard for the markets to be bullish when they're in the lagging category. So speaking of consumers, that brings us to our trade idea of the day, and I want to take a look at Walmart. So Walmart has been really, really bullish. Has earnings coming up here, but has been really bullish until lately. And you can see it's really broken down. It's down 1.25%. It's kind of like the Dow and the Russell. You know, you got the bull tags here late last week, and then finally this week is when we broke down. And the intermediate line now had been in bullish territory for quite a while, with everything else breaking down around it. The intermediate line's now in bearish territory. The market sentiment's still high, but you are 3.5% almost below the 30-day moving average. It's dark pink shading and a red line. You have a bearish weekly candle on a bearish weekly Hakinyashi candle. We have closed below the 10-week moving average, which is very high versus the 40-week, as you can see here. That's a big gap right there. And then if I look at like the 3 green arrow chart, obviously you have 3 red arrows on this, but you're also breaking the 50-day, and there's a huge gap. Again, 10-week and 40-week. So a huge gap here with not very much volume because of that earnings, so the last earnings release. Not very much volume. The MACD is pretty bearish. The stochastics is in bearish levels. All the other oscillators are showing relatively bearish patterns as well. You can see you're above 25 on the negative indicator, well below 20 on the positive. Your ADX is already above 25, and it's starting to turn up again. You look at like the RSI and the CCI, they're both at bearish levels, below 40 for the first time in a long time, and below minus 150 on the CCI. But the weekly CCI shows that there's still more for this to go down, if it indeed is going to go down. If you look at the Ichimoku cloud, we're actually breaking slightly into, it's a wide cloud too, you're breaking slightly into the cloud, and that means a move for the rest of the cloud at least is in play. You have a negative rate of change. We almost have an intermediate trend strength already developing down there at the bottom, and then you can see we are pushing against the lower band and the lower Keltner channel, and in this case the bands have just barely crossed outside. Here we go, finally. You can see we're pushing against that lower band, and the lower Keltner channel ended up closing pretty much right on the lower Keltner channel. But you see the bands for this, the first day with a green dot. So this is the bands are breaking out outside of those Keltner channels, which can lead to more of a move to the downside, especially, again, like I said, with earnings coming up. So what I decided to do was to sell, go to September, sell that low 20 delta, be pretty aggressive, by roughly about $3.50 away or so. Position size for a $500 risk, just like our typical directional trade. But I got a 3-to-1 reward to risk ratio. It's a pretty good reward and a lot of flexibility. Usually when we get this big of a reward, the max gain is closer to this. This is the 1 standard deviation window, so we're usually a little bit closer. I got a lot of wiggle room from a timing standpoint, so it doesn't have to go down immediately. I've got some room to work with and still get a really, really good return. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.